So just to get started, welcome to the presentation on integrated reporting. We do regular webinars on different topics to do with IR, and today's topic will be focused on getting everybody acquainted with the concept and the background of integrated reporting, some of the key terminologies and frameworks that are used, and our intent is to just get the audience a little bit more knowledgeable and acquainted with what IR is and how it can be used in their organization. As you can see on the screen, this is hosted by the IR Lab India, which is a forum from the CII ITC Center of Excellence for Sustainable Development and in partnership with the International Integrated Reporting Council. Now, before I get started, I'll just give you a brief introduction about myself, and I will be presenting today for the next 30 to 40 minutes. I have a background in both corporate and social sector, and I currently lead IR initiative at CII. My background in both these sectors and across different engineering and business operations have hopefully given me a little balanced approach as to how sustainability can be integrated and how it can coexist with businesses. So I'm really glad to share this presentation and my knowledge on integrated reporting with all of you. A little background about IR Lab India. Like I mentioned, it's a collaboration between CII, ITC Center of Excellence for Sustainable Development, and IARC, the International Integrated Reporting Council. It was formed almost 2 years ago and includes membership group which has industry, academia, regulator, and institutional partners. And the purpose of the IR Lab India is essentially like what we're doing today, is increase awareness, build capacity and adoption within the industry on IR, and also hopefully encourage the adoption of IR as we go along. So to get started, today's topic is what, why, and how of integrated reporting, and our agenda today will be to talk about what reporting today is, why integrated reporting, what is IR, and how do companies get started with it. Now let's talk a little bit about what corporate reporting today entails. It can be fairly summarized by a survey undertaken by the International Financial Reporting IFRS and the Accountant Standards Body. This survey was aimed at preparers of corporate reports, which is primarily the industry or the companies and organizations, and its primary users of corporate reports, which are investors and analysts and so forth. And what it provided was a good, clear picture about the problems and challenges on both sides. Despite all the progress, you see both sides have been unhappy with how corporate reporting today is. From a preparer's perspective, there's overload, especially of disclosures. There's a lot of information that is asked in different formats, and it's a really challenge, for companies to prepare a holistic and right kind of report. But despite all of this, from a user perspective, they still feel that there is a lack of relevant data. There is a lack of clear communication, transparent communication. So from both sides, you see a certain degree of dissatisfaction on this. Now, what you have here is, we have a lot of reports today that include the BRR in India, especially. We have BRR, we have the sustainability reports unique to each organization. We could have a GRI, and then we also have our disclosures and the MD&A. You also have, when you put all of that together, you will see that the size of these supplements have increased from tenfold, almost from 50 to 350 pages in 3 decades. But despite this increase, there's a lot of issues regarding the fact that these all tend to be mere compliance focused, they tend to be redundant, and they tend to be disconnected. And so from a user perspective, what you see is they'll describe these reports as verbose, text-heavy, extensive data, compliance-focused. They have a hard time getting the information they need from these reports. And so the big feedback that you get from both sides is that their corporate reports today are put in gaps. Three elements and see where what are those gaps, and then see how IR can fix it. And so we're trying to answer the why question: why integrated reporting through these three gaps that are perceived. The first one is that of the holistic value. So business today creates value in multiple ways. It's not just the investors, but it starts from the investors and owners, which is your financial value. But then you also create value for your communities, employees, and customers. This could be monetary value in terms of payments and salaries, or even qualitative. You create value for your customers and clients, again, monetary or in terms of product or services provided. So put together, all of these create different value structures within the society, which have your job security, you have services, you have increase in self-worth, improving the overall standard of living. And so clearly the definition of value is far more multifaceted today than what is conveyed through purely financial terms. So this is the holistic value that the corporate reporting today seems to be missing to some degree. The second one is that of including intangibles. So if you look at the I'm sorry, I have a little video here which doesn't seem to be playing. Anyway, I'll just for a minute. So S&P 500 companies in 1970, almost 80% of the company's market value could be traced through the tangible assets in financial statements. And today, only about 20% or so can be explained in financial assets, whereas the rest is in intangible assets. And so what you have is there's a lot of gap between what the intangibles are and what the tangibles are reported in the corporate report. So there clearly is a gap between the financials and then the intangible factors, such as relationships, intellectual and human capital. Then the other gap that comes about is the information gap. Now in this one, I'm hoping the slide is pretty clear now, but the information gap is that between what is reported and what the user needs. So here you have the company focus is on strategic issues, forecasts, and past performance, whereas an investor needs long-term strategy. It needs information on the short-term business activities, the medium-term plans, and the long-term strategy. The user, which is the investors, typically need a more forward-looking piece of information, whereas the current corporate reporting is much more backward-looking. So therein lies your information gap. The third gap that we see is that of, I'm sorry, the video is not working again here, but I'll just walk through it. The third gap is that of the various reports. So if you look at when a company publishes report, you'll have the annual reports in March, and then you'll have the BRR, GRI, sustainability reports come out in March, June, and even December. So what results is that for one company, there are now multiple reports made by different groups which are in silos, and then you have the challenge of complete different stories across different reports from the same company. And so the three big points that we had here, which we were trying to make about the why of integrated reporting, is that of the not holistic, information gaps, and disconnected and inconsistent because your reports come out at different time frames with different stories in it. And so here is where the integrated reporting story comes in and how it can actually help kind of solve some of these issues. And so where you have the financial reporting, and then you have the, when I say other, it's your non-financial data that goes out. And all of that is in perspective of the strategy, the governance, performance, and prospects. Uh, what you need is something that combines all of that together and presents one concise communication about the value that the organization creates. And this is enabled by integrated reporting. So what integrated reporting does is provides you a methodology for complete, cohesive, holistic reporting across all the different factors that affect the business and the factors that are affected by the business. So a little bit of what exactly it is. There are three main elements of the integrated reporting process. One is the back end of it, which is integrated thinking, the front end, which is actually the report, which comes out, and the integrated reporting, which is typically shown as IR in the two signs, is the process that goes through. So integrated thinking is what an organization must do internally. It's the relationship between various functional units, between the executive and the employees. It is the decision making and everything that goes in towards how a business creates value. And so clearly integrated thinking is more internal. Integrated report is the actual concise communication on the outside as to how, when you communicate to your investors, which are prime stakeholders, as to how a company creates value in the short, medium, and long term. And how do you get from the internal to the external manifestation of a report is the process of IR, which basically says if you do the right thing internally from the thinking perspective, you will it'll result in a much more clear and concise communication over time. And then the benefits of this, as you can see, is on the internal side, of course, you have more accountability and stewardship. You have a concise message of what the value you create across the organization. If you clearly do a good job of articulating how you create value, it's not just for the report, it's internally that all your board members, your executives, as well as your employees have the same message as to how and what you create value for. On the external, the two big benefits are your report, which is cohesive and comprehensive, and the biggest benefit is it does improve allocation of financial capital. So now your investors do know what your full story is, and they can make more knowledgeable, more data-based decisions on how to allocate financial capital. Now let me go through some more key elements of what IR is. So what we saw in the previous slide was more of an overview of how the internal, the process, and the external bits are. Now let me talk a little bit about the framework itself. The IR framework has three core elements. It has the fundamental concepts, it has the guiding principles, and content element. In the fundamental concepts, you have a piece of 6 capitals. And in short, to explain again what this would be is the fundamental concepts, which let me just go back. These are the ones which explain the foundations or the concept of IR. So it talks about value creation for the organization and society at large. It talks about capitals, which is financial and non-financial capitals. And it talks about the process of how a company takes those capitals and impacts it. So that's the underpinning part of what an integrated reporting process looks at. The guiding principles are essentially, these are the kind of content an IR report should have and how they should be presented. So it helps you in developing the content. So for example, things you report on should be materially important, it should be concise, it should be connected and so forth. And I'll go a little bit more in detail of each one of them. And then the next element is content elements, which is essentially what a good integrated report should include. So in a sense, these are the concepts, principles, and elements elements, the three basic forms of an IR framework, and the six capitals is something that gives you the holistic picture. So let's look at them one by one in detail. It's a fundamental concept, which is the value creation process. So at the core of integrated reporting lies the fact that all businesses exist to create value, and they create value for themselves and the community at large. And so the fundamental concept aims to provide insight is how a company actually uses capitals and then interacts with the external environment and then impacts those capitals over a short, medium, and long term. I know it's a little big mouthful to kind of put all of that together, so I'll do my best to kind of break them down into little bits and explain them a little bit more. So if you look at this particular graphic, on the left-hand side are your inputs, and the inputs are both financial and non-financial. And that's exactly what the input for any business is. You have money, you set up a factory, you use people to provide services, to provide goods. You have the relationships with the communities in which you exist, and you use a lot of natural resources to create those products and services. So in short, these are the six elements that any business of any kind uses to some degree or the other. Now, the amount of it differs. So if you are an IT company, probably your intellectual capital input is higher. If you are a steelmaking company, your manufactured input is higher. That's your left side. That's your input side. Then you come to what is the middle, which is basically the company and how it creates value. So it creates value by its business activities. The business activities are dependent on what the mission and vision and the output the company requires. There is the governance that kind of encompasses how the business should be run, and a lot of decision making which takes place in the context of what the risks and opportunities a business faces, and how the resources should be allocated based on those risks and opportunities, and what the output should be. So if you look at the middle portion, it's essentially your business model. You take your input, your activities, you get your outputs. And then how does all of that work? It works in the context of what governance structure you have, how the resources are allocated, what's the performance expected, what's the performance currently that the company is at, and so forth. So that is how a company actually creates value. That's the business model and strategy. On the right-hand side, you'll see is the word outcomes. This is another very interesting fact of this process, is it takes the definition of your business model a little broader. So you have your input, your activities and outputs, and then some more far-reaching outcomes of that business model. So a quick example for this would be if you're a transportation company, your input probably is raw material, fuel, so forth. Your activity is to convert it into vehicles. Your output is an actual vehicle, but your outcome could be, on a positive side, your outcome is transportation, mode of transport for millions of people, mode of livelihood, because if you're a driver or a logistic provider, the outcome is livelihood. On the negative side, your outcome could also be the impact through pollution and ambient air quality and so forth. So it takes the definition beyond just I make transportation vehicles, I take raw material and convert them into these vehicles, but also the far-reaching outcome of that process. Now, if we move further, then if you take the output and the outcomes combined, what you realize that the capitals are impacted. So you started with your six capitals, each one to a certain degree, and you're going to impact the six capitals again to a certain degree. In this process, you hope a business has gained money, which is your financial impact. You've used and trained employees, which is your human impact. You've built relationship with the communities. You've built a brand, some goodwill, your social and relationship impact, and then either you have used natural resources and consumed them, which is your environmental and natural impact. So if you see, this process is not, it's not static. Each component of it interacts with another component, and each component needs constant revision and refinement to make sure all the others are in sync and are constantly evaluated for improvement. So I hope I've done some justice to this framework. It's fairly simple when you start walking through it, but it looks a little complicated with all the arrows. But essentially, it is what a does, or any organization does today, and when you're trying to do something to create value for society. The next part of this was the guiding principles. Now, we talked about guiding principles. What they are basically principles. They are not any sort of mandate. They are not any sort of indicators, but just something that an organization should keep at the back of their mind as they prepare the report. This defines how a company can go about creating systems for the report, collecting information, and then how it will be presented. And the certain key elements of these are that a company should look at the future and a strategic focus when it's trying to generate information for the report. It should look at how everything is connected. And this is a very big element of integrated reporting, and hopefully in one of the subsequent webinars we'll delve deeper into it. But like the previous value creation framework showed, everything is connected. You cannot look at it individually. If you cut down trees to put a factory, there is a connection between nature and manufacturing and financial and impact on society. If a company is training employees, there is a connection between the financial impact as well as the human and the intellectual impact. So if you're making decisions for the future, your past performance is linked with your current business, is linked to your future orientation. So nothing in a business is disconnected, and this connectivity has to clearly come through when you're preparing and presenting a report. Stakeholder relationships, that's talked about pretty often, so I won't go into that in detail. Materiality, again, a very common concept. It's just used a little differently in integrated reporting. It's used in terms of what is materially important for your prime stakeholder, which is your investor or providers of financial capital. So the concept of materiality remains the same, but the focus shifts towards what is required to be reported on that will help an investor make a wise decision. So that's the little switch from the other concepts of materiality we've seen before. A report should be concise, it should be reliable, consistent, and comparable. Very straightforward concept that you have to present something that can be compared year on year with your own company as well as peers. You have to present something that's reliable and complete. And by that, both positive and negative impact should be shared to give a full story. Like I said at the beginning, these are principles. They help preparation. They help prepare the content. How to present them, how much to disclose, how not to disclose is where a company needs to take its judgment and go forward between. There is always a sort of a tension between disclosing too much, being too complete, but at the same time being concise and reliable. So that's the judgment, and that balance is what a company should kind of look through and learn as they go along this IR journey. The last bit of the framework was the content elements. These are things that should be in the report. Again, not an indicator, but in some way, these are pieces of information that a report should capture. It is basically the questions that need to be answered. It is a story that needs to be told about the organization. Let me emphasize, this is not a set sequence. You don't see a report exactly with these as their content bullet points. These are, again, not isolated. They are not standalone sections. but this is the information that an integrated report should have. And just briefly going through them, it basically, again, tries to summarize what an investor is or your stakeholders are looking for. What is this organization? How does it exist? What's the governance structure? What's the business model? What are the risks and opportunities that are foreseen? How is the strategy developed based on that risk and opportunities? How are resources being allocated? Your current performance, where you see the company moving ahead, and then a little note about how this information was gathered and prepared and the reliability of it. So that's it, essentially what the content elements are. Again, they don't have to appear in sequence. They don't have to appear in isolation. They just have to kind of blend together and present a cohesive story. And one of the things to emphasize here is that one of the idea of using the words connectivity and materiality and conciseness and basis of preparation, the idea to use that is to make sure that the burden of reporting for an organization is not increased, but actually decreased, because they're now being more coherent and they're presenting it in a very, very concise way versus having to repeat and present redundant pieces of information. So the hope is to actually be a simpler, straightforward corporate report than multitude of reports in different directions. So while I've told you what is IR, I will quickly go through what it is not, because this is frequently asked during our webinars and in-person sessions. So let me just go ahead and kind of clarify that. An IR is not a list of indicators. Everything that you've seen in the previous slides are principles that have to be applied. Are good practices and content elements that have to be presented, but it is not indicators. It is not a yes/no checklist. And because it is not a yes/no checklist, it is not there is no good or bad IR. Typically, from the past couple of years, the experience has been a journey, cutting and improve as long. So there is no good or bad or perfect integrated report. It is just your integrated report for your company and how you improve it. And it's a principle-based format. It is not prescriptive. It is not another reporting format. So you will not see annual report. Hopefully, you will not see an annual report, sustainability report, an MD&A, management discussion, board report, and an integrated report. No, that is not the purpose. The purpose here is more that integrated report is at the top, and everything else are the branches as required data sets into it. And I'll also clarify here that at the IR Lab India, especially in India, it is we strive really hard to make sure we communicate this, that we are not looking to make this another corporate reporting format. We are not looking to add to the burden of reporters right now. We are just trying to very clearly bridge the gaps and simplify the existing kind of convoluted corporate reporting that exists. Another question that is frequently asked is this sustainability initiative? And no, if you looked at the value creation, or if you looked at the content, or anything that I've said so far, I have focused on intangibles and measuring intangibles, but sustainability is not the focus of integrated reporting. Sustainability is a key element of integrated reporting because you're trying to bring that conversation into the mainstream. But the idea is that it has to be holistic. You can't just look at the intangibles and the sustainability measures and leave the financial ones out, and vice versa. So it's an evolution of corporate reporting. It's not necessarily an evolution of sustainability reporting. The next one is that the most common question asked is, oh, this is going to be a compliance challenge because we are going to report on things that we shouldn't be reporting on, and disclosures that will get us into trouble. Of course, I can only state as authoritatively as I know, but I can state it based on the experience IARC brings to the table also, is that there is no indicators, there is no list, there is nothing here that says a good or bad IR. So clearly, there is no compliance issue right now where you have to report on something, and if you don't, you're going to be penalized. That's where the judgment piece comes in. The idea is to share information that is relevant, share information so that investors don't make assumptions, share information so that your stakeholders are not reading between the lines and making the wrong interpretations of your actions. Share information that helps good decision making. Clearly, nowhere does it say share all the information, share everything, that can cause a compliance risk or a competitiveness risk. That's where the judgment comes in, and that's where the companies also have to realize that a lot of information already exists. It's just taking that conversation and control of it and presenting it in the way the company wants the stakeholders to hear it, versus letting them interpret based on data available around. And the last piece of what IR is not is it's not a one-step process. Again, we're asked very frequently, I want to do an IR next year, and give us a list, and we'll go through the list and we'll be compliant next year. First of all, there is no compliance. Second, it's not a one-step process. It involves some internal changes through the thinking part of it, some process changes, and then you see the report at the end. It's an iterative process, which typically so far has taken companies 3 years to go from their current reporting to a good integrated report. And there are different ways companies start on this journey, and different ways they can choose to move ahead. But again, it's not one step. So how does a company get started? I think there are many different ways a company can get started, but one of the key, most common practice is to learn from those who've done it before. That's, I think, what we're doing today. It's a process of learning. The second is to assess your current report, and that's where the gap analysis comes in. Now, the gap analysis helps you identify where you are and how much information is required to get to a good level of integrated report based on the framework. And that can help define where and how the process should be. Based on that, you can set your ambitions. And by that, I mean you can decide whether you want to go full-fledged into integrated reporting. You want to just have a small section in the management discussion analysis part. You want to start including more capitals in your reporting. So you could have multitude of first steps, and that's where you decide what your first step is and how long before you get to the optimum level. The fourth step is get buy-in, which really is also, you could almost make it the number 0, or the precursor to everything. Is somebody has to be the champion, and usually we recommend it has to be the board or the executive level, which has to be the champion of integrated reporting. The reason being, it's not an isolated finance or sustainability function. It's across the company, and it works best if you have a champion who can drive this across the company. And since it involves strategy, business model, outlook, a lot of elements which the board is involved in, it really benefits from getting a buy-in from them at the very beginning. Then, of course, comes the recognition of that it is a journey and what needs to be changed and how do we move ahead with it. Like I said, just building on the previous slide, when you start with, there are a few decisions that need to be taken internally. One is, of course, building your team, your board buy-in, your leadership support, and a cross-functional task force is critical. This also highlights that a good IR is not usually just a sustainability initiative, or it is not just a company secretariat kind of compliance initiative. Anyone can lead it, but it has to be cross-functional. That's the only way you get the full value of it. In some companies, the investor relations team is the executive champion, and then has a cross-functional task force. So there are multitude ways, but the underlying part is it's not one department, but across quite a few. And then the internal decisions, of course, is the gap analysis. What's the timeline for reporting in terms of how long do you think this journey will take, and how do you get started? And then the key next steps will be your stakeholder and your materiality, because your stakeholder now becomes your investor and your provider of financial capital. That changes the dialogue a little bit, and then the materiality based on that. Once you've figured these two, I think one of the other things that comes to mind is examples. Who else is doing it, and how can you learn from? So here are the companies who are doing integrated reporting. Some in India, so a majority of them outside on a global stage. These slides are from IIRC's presentation from a few months ago. So now I'm pretty sure there are many more than 1,000 organizations who do IR, because we've had the new cycle come through and a lot more companies come through. But what you see is a lot of companies at the global stage are slowly moving towards using this framework. A lot of the CEOs, CFOs, and COOs are moving towards integrated reporting. And those who are not moving say that they will very soon move towards integrated reporting. Again, a very big indicator of how important this is across different functions beyond sustainability. There are 750 networks. We are one of the networks, but almost every country, every continent has its own network. And there's some key interesting facets. I've put Japan as an example here because it's sort of closer to home, but there's 180 businesses in Japan who do IR, and this was a lot to do with the Japanese Prime Minister, Mr. Abe, who kind of highlighted corporate reporting reforms and integrated reporting specifically to help businesses refocus and help investors invest in long-term value creation. So that drove and is still driving a lot of Japanese companies to do it. Even nearer home, the Singapore Stock Exchange itself produced an integrated report and encourages all the companies listed on the stock exchange to go ahead and use the framework. Then for the South, you have South Africa, of course, which everybody knows. The Johannesburg Stock Exchange has now gotten the King 4 Code of Governance, which has come out. And you have the European Commission, which talks about IR as a feature of corporate reporting. And in the UK, there's a portion called the Strategic Report, which is very similar to what companies have to do through an IR framework. So across the world, there's a lot of activity, each to a different degree. Some voluntary, some mandatory, some highly recommended, but moving in the same direction. The companies that we are involved in regularly in the Indian diaspora, GE, Coca-Cola, Clorox, some of the big names, Mitsubishi, SAP, all doing integrated reporting. Specifically Indian companies, Tata Steel, a pioneer, it was involved in the pilots of integrated report. They've over time, they're a good example of a journey where they started with different facets, and this year have come up with a much more comprehensive integrated report. Yes Bank and Wipro are the two new entrants this year from the Indian businesses. Yes Bank chose to focus on multitude capitals, so they pulled the dialogue on capitals and expanded it in the sustainability reports. Wipro used the management discussion section to talk about capitals and their work, and use the framework in that section. So very different approaches, all very valuable and all appropriate. I'll just quickly run through a few good examples. I have probably 5 minutes more, so that should suffice. One good example, GE. They came up with their annual report this year. The quote from CEO Jeff Immelt kind of summarizes, what I think a lot of companies are looking to do is, for investors to make investment and voting decisions, we don't believe that more information is better, but better information is required. And they've already been enhancing their reporting in the last couple of years, and now they're taking it even further by using the integrated reporting framework. And as you can see, they've shown they found a way to connect business and environmental impact. They've got the connection. They've shown two capitals. That's the green portion on the left side. And they've also shown connectivity through the different cycles that businesses go through. So they've got the last about 15 plus years kind of shown over there as to which businesses went up and which went down and how they've all played together, and how GE has capitalized on these industry cycles. Again, two different examples of how connectivity can be shown, used to show your story. Another new entrant this year is ArcelorMittal. Their US-based business chose to go with the IR framework. And the reason for this is that they're very keen on linking their business goals and strategy to the overall sustainable development outcomes. So they've taken that angle of your business, the holistic part of it. We are reporting on financials and a lot more of the sustainable development indicators. And if you look further into the report, you'll see that they have 10 development goals which go across not just their own product and resources and people, but the impact on energy, carbon, community, and so forth. One great example that we at the IR Lab really love is BASF, and that's because I think that their 2015 annual report does a fantastic job of showing the value creation model. And so if you remember the value creation framework, the input capitals, the output capitals in the business, this is very similar, but it's actually got quantitative and qualitative measures and quite a few of them. So on the left-hand side, you have the foundation and the inputs. And the inputs include raw materials, it includes financials, it includes the hiring aspect, the training aspect, and so forth. The middle portion is the business model. What's their mission, vision, how that is linked to the day-to-day practices. And then the right-hand side is the results. And the results here, of course, again, in terms of results on the business, results on the community, results on the environment, water, which is, for example, the water usage, groundwater, the emissions, and the carbon emissions, and the steps taken to reduce that impact. So very clearly one page, which though here is not as clear because it's the font size is really small, but when you look at it, I would highly encourage you all to look at it online, very clearly articulates what the business is. And in nowhere does this create any kind of a disclosure issue or a competitive threat or a compliance issue. They're sharing the information which is probably already known, which is already in the report, but in a much more concise and clear manner. So with the 3 examples, we'll quickly summarize with what the benefits of IR are. And this comes, I've talked a little bit about benefits internally and benefits externally, but this comes from some of the surveys that IIRC publishes frequently. And you'll see that 79% in South Africa, where this is mandated, think that this process and the report has increased the quality of dialogue with shareholders and stakeholders. So clear communication, transparency is one. It increased internal understanding of value creation, very important, very internal benefits. A lot of the participants in companies believe that investors now understand this much better than what they did before. And this is another very interesting finding is investors believe that 80% of investors believe that the quality of reporting shows the quality of management of a company. So clearly, if your reporting is not good, it reflects poorly on how a company is run and what's happening behind the scenes. And this goes to the process where the internal thinking and the process is manifested in the report and the link back and forth. So with that, I kind of just want to leave all of you with one slide that I really think summarizes what integrated report is, and that is that this is a classic BMW ad. I think many of you all must have seen it. It shows how many pieces, and all the pieces are similar to any other car that goes into making of a car. But it's the way these pieces come together that makes a BMW a BMW. So all the pieces of information that currently exist in corporate report are not unique. They've been around for a while. They exist in different formats. What's key is how these pieces are put together and how the storyline is weaved, and that's what makes integrated report unique. Is that the whole is much bigger and better than the sum of all the small pieces that go into it. And that's what companies should strive when they look at adopting integrated report. So quick last slide on how we can help. Here at the IR Lab, we have, as like I said, a membership of companies and institutional partners. We help with developing a peer network for companies. We have different knowledge platforms through newsletters, webinars, workshops. We provide training, have companies set the process. We've also started offering gap analysis recently to our, not just our member companies, but to other Indian businesses who want to kind of understand where they are and how do they move ahead with integrated reporting. So any questions on that, please connect with me after the webinar, and I'll be happy to explain. Or you could visit our website, and that has an integrated reporting section that explains what we do and why and how we do it. Okay, and with that, I will conclude. We have about 10 minutes for questions, so I'm just going to look through quickly what kind of questions have come in.